EU President Jean-Claude Juncker says achieving economic growth will be built on greater integration. But is that possible without a revival of manufacturing across the continent? Joining me from Brussels, Hans Hock, a former EU official. And in studio, we have John Mills, an economist. Gentlemen, first off, do you think manufacturing is really the way for all of the EU member states to experience a stronger growth story? Hans, I'll throw you the question first.
Manufacturing can certainly contribute. The high value-added services-based economies that has been for a long time what economies were banking on, including the UK, Germany, etc. It's become clear that you need manufacturing alongside that for an economy to be resilient and growing.
John, is an overstatement of the situation if you say manufacturing is that meal ticket?
Well, if you look at the statistics, economic growth tends to come from investment in machinery and technology. And the reason why the European economy is growing relatively slowly is that investment in these parts of the economy has gone down and down and down and is now at a very low ebb. But perhaps most crucially, if countries can't produce enough to pay their way in the world, they haven't got enough to sell to the rest of the world, they run into balance of payments problems, and then their economy becomes stultified by deflation. So there are very strong arguments for having a strong manufacturing base, and I think the reason why the East is doing so much better than the West at the moment is because so much manufacturing is now concentrated along the Pacific Rim instead of in places like the European Union.
Sure, but John, the argument that you want to blame outsourcing hotspots for the problems of national economies is one that doesn't always stick. I mean, Paul Krugman, he says that it's a wrong assumption to make that every dollar of manufacturing exports or imports corresponds to a dollar of manufacturing value added.
Well, I think it depends where the cost base is lower. The cost base is all the costs that are incurred, which aren't raw materials and machinery and so on, for which there are world markets. It's all the locally determined costs. And if these are charged out to the rest of the world at a very high rate through the exchange rate, which is what has tended to happen in the West, then all that happens is that manufacturing, which is very footloose, just tends to drift off to other parts of the world. And that's what's happening.
But then, John, what do you say to economic observers who have been able to rightly identify that even the East Asian tigers, the real top-tier players, the Chinas, for instance, are transitioning towards the service-based economy?
If you look at what's happening in places like China, what is occurring is that the service sector is becoming more important, but that's partly because costs are falling and falling in the manufacturing sector in relation to the quality of the output. So there's a kind of statistical illusion here that manufacturing is becoming less important. Now, actually, I don't think that this
But are
is
they
really
losing
happening.
out to smaller East Asian tigers that are producing in a more robust manner when it comes to manufacturing?
To some extent, I think that's true. I think what is happening is that manufacturing is spreading to more countries, like Vietnam, for example, although China still has enormous advantages because the infrastructure is so much better there, and also because they've got such a depth of manufacturing that they've still got a huge amount of momentum behind them.
Hans, let me throw it to you. Do you think it's naive to assume that we could be seeing the 1990s heyday of double-digit growth tailored specifically as a result of manufacturing?
Unfortunately, I don't think we're going to be able to see double-digit growth in the near future in Europe, but I think repatriating some of the manufacturing is something that the US is focused on, and I think the EU also hopes that some of the manufacturing would come back.
How can we even begin to imagine a more robust EU manufacturing base without more fiscal centralization at the EU's, which means a transfer of democratic powers over to Brussels?
I'm not sure we need more fiscal harmonization in that sense. I think what you do need, and this was mentioned before as well, you need more investments in infrastructure, because manufacturing can also be very high quality, innovative in production, and Europe has lagged behind in investment. So I would tend to put the focus more on increasing investments rather than moving more powers to EU in the fiscal sense.
John, do you think that's the way to do it?
Well, unfortunately, I think that investment in infrastructure, however desirable it is, doesn't do much to increase economic growth. What increases economic growth is investment in machinery and technology.
You can have those physical items in your country, in your backyard, right? But if a company wants to grow, they're going to have to look for loans. So doesn't the EU play a role in terms of financing those loans, ensuring that there's more harmonization so we don't have credit pools that perhaps larger in one part of the continent, smaller in others?
Well, there's some interesting research that's been done about a shortage of credit. I mean, if the economy isn't growing, then companies don't really need more credit. The ones that do need more credit are the ones that are really capable of growing. And there, the shoe has been pinching a bit. But part of the problem is that banks are under enormous pressure to improve their balance sheets at the moment, and one of the best ways for them to do that is to restrict the amount of lending that they do. So we have got a real problem here of policies pulling in different directions.
Yes, Hans, let me give it to you. We have a liquidity shortfall, wouldn't you say? And how is that going to be addressed?
This is an analysis that most people would share. And at a time when banks are still repairing balance sheets, the bank lending is low, but there's a demand aspect as well. But there's also a link between the banks in countries and the availability of credit. So there's more credit available in certain parts of the EU than in others, whereas there might be very promising companies in other parts of the EU. And this is exactly what is the idea behind something called the Capital Markets Union that the Commission is stimulating, which is a way to create more non-bank financing and make the EU economy less reliant on banks for the financing of companies.
Okay, John, I'm going to give you the last word. Do you have faith in the EU to create simplified financial instruments that are going to allow the manufacturing sector to grow?
I'm not very optimistic, to be honest with you. I think every little helps, and if the EU can do something to improve the flow of funds, that'll be a plus. But I think it's a very small part of a much bigger picture.